The stock market has had a great run over the last several weeks here, and the question really becomes is this rally sustainable, or can we expect the market to potentially come down quite severely over the next several weeks and months? And that's the question we're going to attempt to address in this video. But before I get too far into it, don't forget to smash the like button for the YouTube algorithm, subscribe to the channel, ring that notification bell, and let's get into it. It's important to set a little bit of context, so it's important to understand what's been going on over the last several months here. Has there been a significant changes to the causes that drove the decline in the stock market for the beginning part of the year? So what were some of those reasons? What were some of those causes that resulted in the decline in the stock market at the beginning part of this year? Towards the tail end of last year and going into early this year, there was a significant amount of optimism in the market. There were lots of discussions on the metaverse, and NFTs and random tokens were rampant in the cryptosphere. And companies with no earnings, or companies that weren't even real companies but were looking to become companies, i.e. this is the SPACs that I'm specifically referring to, were all the rage. For the first time in history, used car prices were going up, housing prices continue, and are still continuing for that matter, to go up. Things were, after all, pretty cool. But then something changed, and fear effectively hit the markets like a ton of bricks. Things such as rising inflation, commodity price inflation, the unexpected war in Europe, China going into lockdown, after lockdown as they continued to follow the zero COVID policy, resulting in the supply chain not improving, daily talks of threats of the yield curve inversion, scams in the crypto market coming to the forefront, startup funding dipping, the Fed tightening the Fed funds rate, and tech layoffs all seized the market and effectively sent it into a tailspin. At its worst, the Nasdaq was down over 30%, the S&P was down over 20%, both of which were effectively in full correction. Then something happened around mid-June. Around mid-June, the market started rocketing, and now it is where it is, where the Nasdaq has effectively cleaned up its mess and is back up about 10%. So it was down 30%, now it's only down 20%. Similarly, the S&P 500 was down over 20%, but it's now only down 13%. And there were trends in the market. There were economic factors that if you looked in the marketplace, it would be like, oh yeah, some of this run-up is justifiable. So perhaps this rally is going to continue to persist. But what were those factors? For example, there were meaningful signs that would suggest that inflation has peaked, and while it may remain elevated, it wasn't going to go across that 9% marker as it did last month again, which means that the Fed shouldn't be so hawkish and wouldn't crush the economy with rising rates 75 basis points every single month. Now, this doesn't take away from what the Fed has already told us. They've already told us 75 bips the next month and then 50 bips the following month. They've already talked to us about that. But the question becomes is, will it keep going from then on to achieve that terminal rate of 3.5% to 3.75%, which the Fed has also potentially indicated in the prior announcement? Separately, and also commodity prices also started declining. Take a look at the price of the pump, if you will. And there's also signs that the economy is contracting, and that is actually being viewed as a good thing, because a contracting economy generally means that the Fed will not continue to be as hawkish as it is on the market right now. After all, there has been 2 consecutive quarters of negative GDP growth. In this video, I'm not going to talk about whether that meets the technical definition of a recession or not, because it does, but apparently there is some level of confusion that has all of a sudden emerged on what the technical definition of a recession is or isn't. The positive side, earnings of companies continue to exceed expectations. Yes, there has been some earnings revisions for certain companies that have taken place, but with that said, it has been few and far between, and companies continue to outperform, which also demonstrates the health of the consumer, and consumers continue to have a high degree of employment, and wage rates continue to increase, which is also absolutely a good thing. And the latest job reports was basically indicative of that, where you had about 528,000 incremental job openings that were posted in the market. Well, these are positive forces. These are positive forces that are basically coming in and saying that, hey, maybe we can expect this trend to continue and the stock market should continue to prevail. But the question really becomes is, where those factors that were originally occurring in the market at the beginning part of this year that caused the market to dip, are those factors effectively been treated or been fixed such that the outcomes would effectively be something different? So let's talk about those factors one by one and address whether they have changed significantly for the market position to potentially continue its upward trajectory, or maybe see a bounce back to where things were in the next several weeks and months. And so let's perhaps start with inflation. Yes, inflation may have peaked, But when it comes to commodity inflation, the war in Europe is still raging, and there's no armistice in place. It'll take a lot longer to have the necessary fuel available, particularly as Europe enters into the winter months. There's going to be a higher demand for fuel, which will of course create the need and potentially drive up the prices for commodities. Then there's of course China. Yes, it is true that they have opened up, but that is helping with supply chain at this point. But with that said, this is being partially offset with all the commotion that is taking place around Taiwan. And I know there may be some level of comfort that the CHIPS Act is in place and the United States will be producing its own chips and reduce reliance on Taiwan, but that's going to take years and years to manifest itself. So that whole China thing, yeah, slight improvement in supply chain, partially offset by Taiwan, so it's kind of like a flat, if you will. It's not necessarily gotten a whole lot better or worse. On the yield curve inversion, there was a whole lot of hullabaloo at the beginning part of the year around that. Well, guess what? The yield curve has been inverted now for the last several weeks, which is usually an indicator that the things in the economy are not operating favorably, at least in the short term. When it comes to the cryptosphere, things are not a whole lot better either. Yeah, we haven't heard about as big of a collapse as the Luna thing earlier in the year, but yes, the regulatory bodies are continuing to look more and more into the cryptosphere and trying to identify issues thereof, which I am sure there will be more and more cases that naturally come out of that whole thing, and there may perhaps even be other exchanges and things like that go belly up as well. Jobs continues to be the focal point. Job continues to be the positive thing in this whole thing. Jobs, there's lots and lots of available jobs. It's almost like impossible if you are looking for a job not to have a job in this kind of a market environment. But with that said, it's also creating wage pressure. When you have wage pressure, when you have a large number of jobs, you're going to naturally have inflationary pressure as an outcome of that as well. Also, irrespective of rising rates have now started declining in the housing sector. So you have money in people's pockets as a consumer is doing so well, and now you have them having money, rates are coming down. You're going to have more pressure on the housing market, which will continue to inflate the housing market because the supply-demand imbalance isn't resolved either. And of course, there's this other factor out there, which results in fiscal stimulus or spending, which is continuing to persist at this point as more and more legislation is coming out, which effectively is pumping more and more money into the economy that is going to continue to drive up inflation. Now, the only thing that sort of like isn't factored into this bearish outlook, into the future state of the stock market over the next several weeks and months, is perhaps a significant correction that took place in the market early in the year. Yeah, the NASDAQ fell over 30%. It was a significant contraction for all intents and purposes, and perhaps the market is in this impression that yes, we overcorrected and now we should perhaps come back a little bit, normalize this slightly. With that said, a case can easily be made that there are several stocks in the market that are still fundamentally overvalued. The question becomes, is there a continuous cause for optimism on whether the market will be up or down 6 to 12 months from now? Because the case can certainly be made that a lot of those factors from the beginning part of this year have not resolved themselves, due to which there could be an adverse outcome in the next several weeks and months. But what are your thoughts? Include those in the comments below, and if you have made it this far, don't forget to like and subscribe, and I'll see you in the next one.